Well, the space has been bad for the last year and a half. Credit spreads had tightened somewhat. Valuations are really attractive on next year, and a lot of that is around the recession fears that have been built up over the last 6 months. That's mostly baked in here. And then really it comes down to how bad the CPI is. And as the Fed finally caught up, it seems like the leading indicators on commodities are a lot better. You can pick almost any commodity, and they've come in 20 to 30%, which is good. We're still concerned about wages. That's a high percentage of costs. And the jobs report on Friday gives us some pause, but we still think we're probably in an inflation scenario that's going to be looking better. And you couple that with valuations and the fact that you can really stock pick in a really inefficient small cap space, it leads to some opportunities for some absolute and relative outperformance.
And I should mention you're not the only one who's constructive or positive here. Carter Worth just put out a note this morning saying he likes the setup from a technical position. So do you think kind of the index broadly, or would you tell people be careful of buying the broad basket and stick with individual names here?
Well, in small cap, I think it's better to go with individual names just because it's inefficient. You can add alpha there. But that being said, I do think the broader small cap space does look attractive just because it's pricing in asymmetrically a bad scenario for next year. And there's obviously a probability where it could be okay or even better than that. And you have a lot of upside if that plays out.
So let's talk about some of them. Celsius, but not that one. But yes, the one you heard about in the news recently. Zoom Info, which is not the other Zoom. But so go through some of the names that do jump out to you.
Yeah, so we did play some offense during the drawdown in the space and in tech. Zoom Info is growing its revenues at around 45%, and its 40% operating margin is trading around 35 times free cash flow. So it's great growth and great value. They had a great earnings report and plowed through any sort of slowdown that you've seen in the economy. It's a Salesforce optimization tool, and enterprises are obviously latching onto it. Celsius is an energy drink company. They just signed a Pepsi distribution agreement recently. It's growing at over 150%. We think they're going to do well, whether there's a recession or not, given the market share opportunities. The market's pricing in around a 7.5% market share. We think it could potentially be double that or even higher, given the quality of the product. And we also like,
Go ahead, please, yeah.
We also like Kinsale, which is an excess and surplus insurer that's growing around 40%. The street's expecting around 20% premium growth next year, and it should outpace whatever inflation is. We also like Chart Industries, which is an energy infrastructure supplier, and obviously there's lots of investment happening that all over the world, given what's happening with energy scarcity and the need for independence there.
That's exactly what I was going to say, is aside from your kind of situational plays, you've got some of those themes that have been working this year, whether it's energy or insurance, and then a couple of names play them. As we go, anything you'd sort of caution people away from?
Well, consumer is obviously tough, so that you could have some bad earnings revisions there. But that's really the only area that I see from a top-down level being bad. And obviously any of the meme stocks are things that are speculative in nature. I'd stay away from those.
But it's a good reminder, you know, when the consumer is the weak spot, but also the most visible one, that it can be confusing when you see those headlines and draw too much of a conclusion from it. Brian, we'll leave it there. Thanks for your time today.
Thanks.
Brian Smoluch from Hood River.